When you have a child, your immediate instinct is protection. You want to shield them from risk. Financially, that instinct translates into a powerful urge to find the safest place to store money, lock it away, and never worry about crashes. In India, that usually means turning to traditional comfort zones, bank fixed deposits, the public provident fund, or emotionally branded child insurance plans. They promise peace of mind and guaranteed returns. But we need to look at what you are actually saving for. A premium domestic degree, whether it's engineering, medicine, or a management program at an institute like IIM Ahmedabad, carries a massive price tag that grows every single year. The quiet threat destroying those safe savings plans is education inflation. While normal household inflation in India hovers around 5 or 6%, the cost of higher education climbs at 10 to 12% annually. A guaranteed 7% return on a fixed deposit grows your money in a slow, linear line. Meanwhile, college tuition compounds exponentially at 12%. Every year that passes, the actual cost of the degree accelerates away from the money you are saving. Prioritizing zero short-term volatility through these safe products guarantees a severe loss of purchasing power by the time your child turns 18. Let's map out exactly how this plays out if you start saving the day your child is born, giving you a 15-year horizon. This graph shows how a traditional tool performs over 15 years. The bottom line is general consumer inflation at 6%. The line right above it is the PPF return at 7%. Your money is technically growing, and it closely tracks normal living expenses. Now look at the top, steeply curving line. That is 12% education inflation. By year 15, the gap between the safe 7% return and the 12% tuition cost is massive. That red space is the guaranteed shortfall. It represents the exact deficit in your purchasing power. Your capital is safe, but it is mathematically incapable of paying the final tuition bill. To outpace a 12% inflation hurdle, you need assets designed for long-term growth. Diversified equity funds, for instance, have historically delivered average returns above 14% over 18-year periods, offering a path to bridge that red gap that traditional fixed income products cannot match. Securing your child's future requires a psychological trade. You must give up the illusion of short-term safety for the mathematical reality of long-term equity compounding. The insurance industry knows parents are anxious about these future costs. Their solution is to package subpar investments with a life insurance policy, slap a picture of a smiling graduate on the brochure, and sell it as a child insurance plan. When you pay a premium into a traditional child plan or a ULIP, your money is split. One fraction goes toward the life cover, and the remaining fraction is actually invested. Neither job is done efficiently. What you don't see up front are the premium allocation charges, administration fees, and severe penalties for early withdrawal. These hidden costs quietly erode the long-term yield of the investment portion, usually dragging the return down to 5 or 6%. Look at this comparison matrix. The alternative strategy is to separate your insurance from your investments. You buy a pure term life policy to secure your family's baseline, and you direct your savings into an equity mutual fund step-up SIP. The difference in efficiency is clear. The equity SIP provides total transparency, low expense ratios, and historical yields between 12 and 14%. The packaged child plan offers high hidden fees and low yields. The catch with the equity SIP is that it requires emotional discipline. You will experience sharp market drops. Your portfolio value will temporarily fall. You have to endure those storms without panicking or withdrawing your funds. The ultimate trade-off is clear. You either endure market volatility to capture growth, or you pay high hidden fees for a comforting label that guarantees you will fall short. The financial stakes multiply rapidly if you plan to send your child to study in the US or the UK. Parents planning for international education face a double penalty. You have to beat the 10% increase in base tuition, and you have to account for currency devaluation. Historically, the Indian rupee depreciates by roughly 4% annually against the US dollar. That means every year, purchasing the exact same dollar costs you 4% more in rupees, on top of the university raising its fees. Saving purely in domestic Indian instruments to pay for a future dollar-denominated expense is a math equation that does not work. The practical solution is to naturally hedge your currency exposure. You do this by allocating a portion of the education corpus into US-focused ETFs or global equity mutual funds, allowing your capital to grow in the currency you will eventually need to spend. To fund an overseas degree, you must either take on foreign market risk to match the currency shift or drastically overcapitalize your monthly domestic savings to outpace the falling rupee. The biggest fear parents have about equity markets is timing. What happens if you rely on mutual funds and the stock market crashes the year before the tuition bill is due? That fear is entirely justified. Holding a portfolio that is 90% equity when you need immediate cash liquidity is financial suicide. You prevent that scenario using a mandatory mechanism called a glide path. This chart shows the glide path in action over 15 years. You start aggressively in year 1, holding mostly equity. But as your child ages and the college deadline approaches, the allocation smoothly shifts. By year 15, the portfolio is moved out of the stock market and entirely into highly secured debt funds. This protocol isolates the exact funds you need for college inside safe, liquid instruments right before the deadline hits, insulating you from a last-minute market crash. It is a deliberate trade-off. You willingly sacrifice potential stock market gains in those final 3 years to guarantee absolute capital protection when the money is actually needed. Effectively counteracting education inflation requires matching your investment aggression to your exact time horizon. If you are a new parent, you have 15 to 18 years before college starts. Your blueprint relies on maximum compounding time. You can start with a small input, like 3,000 rupees a month, step it up by 10% annually, and place it directly into aggressive flexi-cap or mid-cap equity funds. If you are a late starter and your child is already 12 or older, your window is under 6 years. Your blueprint is entirely different. You must allocate heavy capital directly into debt and conservative hybrid funds. You do not have the time to recover from a market crash, so capital preservation is your primary objective. Look at this cost of delay table. It shows exactly how your required out-of-pocket cash explodes the longer you wait to start. The Gupta family started 15 years out, investing a small monthly amount and let the market generate the bulk of their 50 lakh target. The Sharma family waited until 5 years out. They had to contribute massive amounts of their own monthly income because they had no time to generate earnings. Delaying your investment shifts the entire financial burden from compound interest directly to your bank account. Succeeding in funding your child's education requires abandoning the psychological comfort of so-called safe products. You have to embrace the math of the market, buy yourself enough time to ride out the volatility, and execute a strict age-based reallocation plan to protect your capital at the finish line.